I think this is a type 1. 6 marks. Now sometimes exam questions require, if you like, a little bit of common sense and are sort of testing some old ideas. This is, I think, dealing with some technical issues where you do need to understand what is going on here. So let me be slow. The requirement is explain and illustrate. So it's 6 marks, so I'm assuming that we've got 3 marks maybe for dealing with the words, explaining what is going on, and then maybe 3 marks for dealing with the numbers, computing what is going on. The computation could be part of a question number 1, or this whole question could be just part of a question in section B. Explain and illustrate the accounting treatment of the equity settled share-based payments year-end December 16. So it's very important to me that I know where I am. I'm in December 16. On the 1st of Jan 15, which is 2 years ago, 2 years ago we granted share options to our staff, but subject to the qualifying condition that they remain in service for 3 years. So we've got a classic share-based payment which will create an expense over 3 years and build up the equity reserve over 3 years. The fair value of each option at the grant date is 12. It was not expected the staff would leave, but the unexpected has happened and 2 staff have left, and they've left in March this year. Now in 2015 we didn't know that was going to happen, but in 2016 it did happen. Now after the options were issued, the share price collapsed. The options are exercisable at $20. So this means that the employee, if they want to buy the share, they have to pay $20. So if the share price is $22, they are happy because they will subscribe to the share for 20. They will receive a share of 20. They will receive a share that they have paid 20 for, but it's instantly worth 22. So they will make a profit. If the share price collapses and the share price is only worth 15, then the staff are not going to exercise the option. They're not bothered. They're not interested. Yeah, the options will lapse unexercised. It won't motivate the staff anymore to know the share price is 15, but they have to buy the shares for 20. If they work harder, the share price may go to 16, 17, so what? Doesn't motivate them. So what the company has done is it has repriced the options. It has reduced the price of the option, the exercise price of the option, and this gives a further benefit to the staff of $4 a share. Now that second repricing is it's not a red herring, but it is an extra little thing to explain before I start dealing with the numbers. Equity settled share-based payments that are granted to staff as part of wages must be expensed through the P&L, yeah, and spread over the vesting period. Options granted to staff as part of wages must be expensed to the profit and loss account and spread over the vesting period of 3 years. Matching. So options granted to staff as part of wages must be expensed to the P&L and spread over the vesting period of 3 years, matching. Full stop, leave a space, new paragraph. The expense is based on the value of the option at the grant date. The expense is based on the value of the option at the grant date, i.e. $12. The expense continues to be based on the $12 regardless of any change in value. Regardless of any change in value, as it is an equity instrument. As it is an equity instrument. When you issue shares, the expense is based on the value of the option at the grant date, in other words $12, and the expense continues to be based on the $12 regardless of any change in the value, because it's an equity instrument. If you issue ordinary shares and you receive $2 consideration for the issue of the ordinary shares, debit bank $2, credit equity $2. If the value of that share then goes up, the investor makes the profit, but in our accounts, the equity instrument remains the same at 2. We don't change the equity instrument at all, regardless of whether the value goes up or down. So the principle is exactly the same. So this business of repricing is giving them an extra benefit. When Walter reprices the option, this creates an extra benefit which will be spread from the grant date to the vesting date. Right, 3 sentences, yeah, 3 marks, that's enough. Maybe there's more to say, but yeah. I want to get involved, I want to get stuck into the numbers. Now when you're getting stuck into the numbers, try and think of a marker marking your script. So don't just write down numbers, say what those numbers are representing. Now in my world, it's very important that we know where we are. We're on the 31st of December 16. We are effectively in year 2. And in my world, there are 3 ingredients in calculating where we want to be at the year end. So we've got ingredient 1, ingredient 2, ingredient 3, which will then give us our year end situation. So the first of those ingredients is the value of the option at the grant date. Now that is going to be fixed, that is not going to change. That is worked out by an actuary using the Black-Scholes pricing model. So we've got the value of the option at the grant date. We also need to know the current estimate of the numbers that we think are going to qualify at the vesting date. How many will qualify at the end of the day? Thirdly, we have to do the spread. So we have to think about the time lapse. And this will then give us our year-end equity reserve. This will then give us our year-end equity reserve. So, I have my ingredients. I now need to process these ingredients. I have the original story. I'm slowing down for a second. Back in 2015, originally, what was the value of the option at the grant date? 12. The value of the option at the grant date is 12. Now, you did not grant one option to one person. You granted 1,000 options. So you were giving out a prize worth $1,200, and you were giving out a prize worth $1,200 to 30 members of staff. The pot of gold that we're talking about is 30 times 1,200. What is that? 36,000 or 36 million? 360? How much is it? Sorry, my mental maths. 360. 360,000. Now, to me, I've almost finished now because I've got that number. This is the value of the options at the grant date. So I'm given 1,000 options to 30 members of staff. Each option is said to be worth $12. That's a number given to me by the actuary. Now, over how many years are the staff going to be motivated, benefiting? This relates to 3 years. So, rule of thumb, crudely speaking, I would expect there to be an expense of 120, 120, 120. Because this is the gold that is motivating your staff for 3 years. So we spread that over a 3-year period. The trouble is, though, some of the people may or may not leave. And so the actual amount that we end up handing out could vary. So I just need to keep a check on the current estimate of the numbers expected to qualify. Now I'm in year 2, I'm at 31st December 16. Of the 30 staff, how many do I expect still to be there? 28, because 2 of them have already left already. And so that will be 28 over 30. And the time lapse, I'm at the end of year 2 of a 3-year story. So cumulatively, the amount that I have need in my reserve is looking not 240,000, but is something a bit smaller than 240,000. It is 225? 224. 224. Now, I wish that was it, but we do also have, in the current accounting period, a repricing. And the repricing gives you a further value of 4,000. So we've got to bring in an additional value. We've given the staff an additional value during this accounting period. So the repricing took place on the 1st of July 16. The repricing took place halfway through the current accounting period. Now, the repricing is a value of 4. So everybody gets a 4,000 top-up. Everybody gets an additional benefit. I say everybody. How many people were there on the 1st of July? 28. So the numbers that are there are only 28. Of those 28, how many of those 28 do I think are still going to be there at the end? 28. So all that 28 expect to be there. Now this is not 2/3, because this option, this additional benefit, was only granted during the accounting period. So it's only had half a year to go by. Or if I could switch that into months, I might be a little bit happier, yeah, because it has only been there for 6 months. It's a 3-year story. You're repricing it exactly halfway through the period. So you've got another 18 months from the original vesting date. This extra pot of gold is having to be spread over an 18-month period. So what I need to have is whatever 4 times 1,000 times 28, then divided by 3. That is not going to come easily to my mental maths, and I would be grateful if somebody could illuminate what that number is. Is it a nice number? No. Oh dear. 1, 3, 3.
No, there's no way. 3, 7, 3, 3.
Let me have a look. Let me have a little calculation. Yeah, let me get it right. So 4 times 1,000 times 28 gives me that. Divide that by 3. 37, 3, 3, 3. Yes? 37, 3, 3, 3. So what I have here at 37, 3, 3, 3, plus the 2, 2, 4, 1, 2, 3. What do I have here? I have 2, 6, 1, 3, 3, 3. To me, that is an extraordinarily significant number, because that number of 2, 6, 1, 3, 3, 3, that is my balance sheet number. That is where I am at the year end. That is my balance sheet equity. That is my other components of equity. That is in my working six. That's the reserve, that's the equity that I would have at the end of the year. It's not shares, so you can't call it share capital. It's not profits, you can't call it retained earnings. So it's dustbin time, it's other time. Now that's not my expense. That is what I need to have. What I now need to look at is the brought forward. What I now need to look at is the brought forward. What I now need to look at is last year. If last year I had 100, my P&L expense would be 161. If last year I had 100 and I need on my balance sheet 261, then the increase in the equity would be 161, and that's the expense. So what is my brought forward last year? I would only have the original appearing last year. Don't reinvent the wheel. The original has a value of 360. If I turn the clock back a year, how many of the 30 do I think are still going to be there? 30. Because no one's left yet. I didn't know they were going to leave until they left. We've only gone for 1 year out of 3, so last year we would have charged 120. So the increase in the equity represents the expense of the period. The increase in the equity represents the expense of the period. 261 minus 120 gives me a figure of 141,333. This to me is a figure of importance, because this to me is my P&L expense. So my two key takeaways are, on the balance sheet 261 and in the P&L 141. Those are my two key takeaways. And if I was doing a group profit and loss account, I could have to put this in cost of sales. If I was